Greetings, welcome back. My name's David Salem, head of capital allocation here at Hedgeye. Delighted to welcome Brian Schroeder to Hedgeye headquarters for a conversation. Brian is the founder of a firm called OCIO Monitoring. OCIO means Outsourced Chief Investment Office. We're going to talk a lot about that industry, about its favorable attributes and maybe some unfavorable ones. But the larger context, I think, should be of interest to anyone watching this that has any degree of involvement with investing, because we're going to talk about performance measurement, metrics, how you can get it right, how you can get it wrong. That's been Brian's passion since at least the year 2009. And Brian, what I'll ask Eric to do is flash slide 2, which is your capsule bio. People who have seen prior videos that I've done know that I have no intention of reading what's on this slide. It's biography of you. What I am going to do by prior agreement with you is ask you to take the first sort of 2 or 3 minutes here and tell us about Brian's life prior to 2009, which was a pivotal year for you, and then we'll dive in right into the topic of what happened then and what you've been doing ever since. So welcome.
Well, thanks for having me, David. You know, prior to 2009, I have always been a economics, investing type of person. Whether it was watching Wall Street Week with Louis Rukeyser as a child, reading Adam Smith's Money Game in 7th grade. I mean, who does that? I've always had a passion for investing, social philosophy, legal philosophy too. And right out of college, I joined a large mutual fund firm in Northern California. And after a couple years, I had the good fortune of joining a firm in San Francisco that focused on institutional investors, primarily the multi-employer space, which is absolutely the most fascinating, I think, channel in the market. So many different personalities, and whether you're under ERISA or working with the actuaries, changing trustees, they all have different incentives and goals that don't always align. So it made it a very interesting place to kind of learn about the business. And indeed, I did learn a lot about the business, certainly following the .com and the global financial crisis that kind of led me to do something different after 2009.
Yeah, so we all know what happened in 08 and early 09. What happened to you in 2009 and what's happened to you since?
Yeah, well, what was so interesting is my firm was kind of the last great balanced manager, if you will. They're often accused of being kind of a closet indexer. For pension funds, it was kind of the 50-40-10 model, 10 being real estate. Mm-hmm. And like every firm, they're going to have that period of underperformance, that 5 years. I mean, that's the inevitability of active management. But it was following the .com, and what was so ironic is we were in San Francisco, the epicenter of the .com, and we didn't manage it too well. And what happened at the same time, our clients were experiencing this phenomena of unfunded liability. So that combination of underperformance and unfunded liability had them seeking answers. And the answer was to hire an investment consultant, become widely diversified, get all the different manager styles and all the different asset classes. And I had a real inside the ropes view of what they were doing, how they were reporting it, and given some of the things I experienced, I figured that there was a need for someone who is objective, unbiased, isn't in competition with consultants, to provide some objective performance metrics to help clients perform due diligence and fulfill their duties under ERISA and help the overall process.
So let's just clarify for those who aren't familiar, and we certainly have some viewers that live outside the United States. So you introduced a couple terms. Multi-employer plans, where it can be a bunch of unions, a bunch of unionized companies get together, they put money in a pot together and they say, we're going to get economies of scale by investing the defined benefit pension assets on a commingled basis, even though there are multiple essentially owners contributing capital to those exercises. So we'll come back to that, the conflicts that are inherent, both the opportunities and the challenges. You mentioned ERISA, that's the Employee Retirement Income Security Act of 1974. a major piece of legislation in the history of American capitalism that regulated defined benefit plans and then to some extent defined contribution plans. We'll come back to that as well. And then I just want to inject, as we come back to 2009 and what you decided to do with your life, the OCIO industry itself that will be the focal point of our conversation today. I look at it as sort of having started in the year 1987. I want you to get into the definitional questions, and when we get into the new GIPS regulations, we can talk about that a little bit. What precisely is an OCIO? When you think Outsourced Chief Investment Office, well, outsource is sort of obvious. The asset owner is themselves, whether it's a company or an individual or a family, and an endowment. They're not doing the work themselves, they're outsourcing it. We get that. The adjective chief, to me, is always connoted like you have a supervision over everything. Like the CEO of a company is responsible for everything. So that word ought to be taken seriously too. An investment office is pretty straightforward. Hilda Ochoa and her team were running the World Bank Pension Fund in the mid-1980s, and she was able to persuade basically the powers that be at the World Bank to let her go off and start her own firm, Strategic Investment Group. Yeah. And I regard them as, the way I define OCIO, as kind of the founder of an industry that, as we speak today, has grown from essentially nothing in the mid-80s to about $3.5 trillion of assets under management. Depending on how you count, there are at least 100 firms that do nothing but provide OCIO services. And you're helping their clients choose those firms and monitor and evaluate their performance, in addition to doing that with individual active managers as well. So now I'll come back and I'll shut up and let you continue the story. What conclusions did you reach in 2009 about an opportunity for you and a need professionally for really expert help, helping the asset owners with performance measurements?
Sure. Again, I had a good inside the ropes view of going from a balanced manager, again, very vanilla, large cap stocks, investment grade bonds, and core real estate, to again becoming a widely diversified portfolio. And a few years after our biggest client, certainly my biggest client, went down that route, I had lunch with a trustee and I said, well, how's it working out for you? And he goes, frankly, I don't know.
You're still at the balance.
Yeah. I mean, having these conversations, I mean, it's the third rail of investment management. Thou shalt not talk bad about a capital allocator consultant, et cetera. And if it gets out, I mean, there's a pox on your firm. I mean, that was part of the reason I wanted to get out, because I didn't want to open my big mouth and get my firm in trouble. But what I did was I started studying the reports that they were given. And basically, the big problem, the big agency issue with whether it's a non-discretionary 321 consultant or a 338 in our ERISA terms, is the player keeps score. And what I learned is that there are a lot of what I call incomplete feedback loops. And for instance, when it comes to strategic asset allocation, okay, many will change the strategic allocation following a mean variance optimization, sometimes as often as every 12 months, sometimes shorter. And what happens is they will change the benchmark. I call it a strategic dynamic benchmark. So they're constantly changing the benchmark, so the difference between the performance and the benchmark is essentially maybe some tactical, mostly manager alpha, and fees. But because they never tracked the previous strategic asset allocation, how do they know if the changes helped or hurt?
Yeah, the counterfactual. Let's just do a little sidebar. Eric, if you could go to slide 4, I want you to just take 30 seconds, Brian, to explain the difference between 321, 338, where it comes from. Again, the premise here is that there are a lot of people watching you and me talk that have never heard of 321, 338, or the regulatory framework of which they're part.
Yeah, those are sections in ERISA, the Employee Retirement Income Security Act. And basically a 321 is the traditional consultant, where they'll give recommendations. For instance, let's do an active manager hiring. They'll do the screen, they will bring in 3 finalists, you do the interviews, and the consultant says, well, you can't go wrong with any one of them. And the board will make a decision, or an investment committee, and they will take a vote. So a non-traditional 321 makes recommendations, does the research, the board then approves, and then the consultant will then execute what the board has blessed. A 338 is the OCIO. It's a shop that has full discretionary authority to implement strategic asset allocation, tactical hiring, firing, rebalancing, and they also do reporting. However, there are still guardrails put in place. Normally the investment policy statement is also approved by the board.
Yeah, so our audience can see on the table that they can see on their screens. If they look at the row that's distinguishing recommends investment changes under the 321 versus makes the investment changes under the 38 on the right-hand side of this exhibit. So sorry to interrupt, but I wanted to clarify that.
Yeah.
All right, so it's hard to track. I think you've called this in some of your writings. And Eric, if you could go back to slide 3, I just want to encourage folks. We only have an hour, and we'll fill it. There's so much good stuff to talk about. I so admire how opinionated you are, Brian. You're clear, cogent, and highly opinionated. That's why you're sitting here. But you've done an enormous amount of writing. I asked you, full disclosure to our audience, I asked you a couple days ago, I said, give me a list of your greatest hits. I've read everything you've published. But in your judgment, Brian, what are the greatest hits? So they're all on this slide. And I'm going to ask you to talk about each of them in turn. Let's start with benchmark linking, because without using that term, you just sort of alluded to it, the changing strategic asset allocation. What is benchmark linking and why is it so pernicious?
Well, benchmark linking is the standard industry practice today. I referred to earlier about the changing benchmark, total plan benchmark, for the strategic asset allocation. And again, ultimately, if that is primarily the first comparison between total plan performance, and normally the very next line is something called, they'll call it a policy benchmark, a policy index, total plan benchmark, whatever you want to call it. 99% of the time, and again, it doesn't have to be pension plans, it could be public plans, foundations, endowments, you name it.
It could be a family office.
Family office, absolutely.
So it's really total fund benchmark is synonymous with total plan.
Right. And so again, this is really the first piece I wrote ever. And it describes the fact that, again, regardless of the institution type, it is rare to have a true North Star benchmark covering the most fundamental decisions when it comes to success or failure.
Yeah, so you used the term in that piece, and I think in others as well, real benchmark, capital R, capital B. By the way, I'm not sure I agree with your arguments in its favor, but explain what it is, and then maybe I'll give a counter argument as to why I don't necessarily buy into it.
Sure. So again, if the constantly changing linked benchmark is mirroring your strategic asset allocation, again, the delta between your performance and the benchmark, again, is going to be aggregate manager alpha, maybe some rebalancing and tactical.
Yeah, it's going to reflect the differences between the hypothetical portfolio on the one hand and the actual on the other. And those differences, since the asset mix is essentially the same, that's the point you're driving at. It's changing, but the two are the same. It's the difference between the two is going to be the result of active manager alpha, whether positive or negative, in fees.
Right, but you never get an indication of how well those fundamental strategic changes. Let me give you a quick anecdote.
Please do. The more the better.
Yeah, I did a study for a pension plan, and it was the first time, and their consultant was a top 5 consultant. If I said the name, you'd know it, and I'm sure many of your clients use this consultant. Over 19 years, they made 11 asset allocation changes, okay? So, a year and a half. Every year and a half, they were making a change. And I scored their batting average on did it help versus the previous asset allocation. And over the 19 years, David, had they done nothing, they would have had an extra 5,800 basis points just on market beta.
That's a lot.
That is a lot. And the client had no idea that they're constantly using this consultant that has offices all over the country, that is, again, manages assets under advisement, trillions of dollars. And you would think that they did great, but they did rather poorly. And the client had no idea because they never had anyone to, like a football team, break down the tape.
Yeah. In this context, would it be accurate to restate what you just said as they didn't have anyone doing the counterfactual that you just alluded to? What would have happened if we hadn't made those changes?
Correct. The forks in the decision road are never explored.
Yeah. So let's move on to the second piece in your greatest hits, the diversification illusion is what you called it.
Right.
What is that?
Well, again, going back to those years in the 2000s when portfolios were becoming widely diversified, one of the main arguments that the consultants and OCIOs were making was, well, you can't give it all to one manager, and you're not diversified. But if you're looking at the R square and the portfolio movements, compared to peers, they were diversified. You don't have to have 40 different managers to have a, quote, diversified portfolio. Yeah. So the kind of illusion was that if you give it all to us, as opposed to all to one balance manager, but you have this illusion that you have so many asset classes and managers, but again, the true drivers of success happen at the consultant or OCIO level. So to say that it's not diversified using a lone balance manager, but if you give all those macro decisions and concentrate it in us, it's going to look like you're diversified, but the true drivers, again, are not.
Yeah, there's an irony here for me sitting in this chair in this room, because before, in fact, what caused Hedgeye to recruit me to come in and build what we're building in capital allocation was a conversation in this room in front of these cameras with our founder, Keith McCullough, who unfortunately is not here for you to meet today, where I was saying, in essence, over the course of about a decade of being a client of Hedgeye, I came to a conclusion that's not dissimilar from what you just voiced, which is that almost every major allocator that I had the privilege of working with earlier in my career were themselves trying to synthesize an overwhelming inflow of both noise and signal to try to get a coherent view of the world and in turn to try to get a sensible portfolio put together, without recognizing that they themselves, by virtue of adopting that arrangement, had become, what? A single point of failure, or at least a potential point of failure, right? And that's basically the argument you're making, is that you arrogate all of the responsibility yourself as an OCIO. It can work out splendidly. And by the way, absolutely. I do think in many cases, as you know well, and I think our audience members know well, for the lion's share of my career, almost 20 years, I had a lot of help, but I founded, as a CEO and CIO, the Investment Fund for Foundations, which when we launched in the early 1990s, there were not 100 firms managing 3.5 trillion. Hilda was up and running, and Hurdle Callahan, and there were some other shops that had an OCIO, but it was a vastly less crowded playing field.
Right.
And I think TIFF and many other OCIOs have done a great job and this is the counterfactual. They've delivered, I think, satisfactory returns, but in most cases, those returns are vastly superior to what the institutions would likely have earned if they had stayed with the old model, right? Which is having the consultant come in once a quarter and having a beauty contest, right, and managing everything with their eyes in the rearview mirror, chasing performance, right, and all of the above.
Yeah, if I could put an exclamation point on that. I do believe that the OCIO model is far superior to the traditional non-discretionary model for the simple fact of eliminating conflicts of interest. Yeah. The delays, and everyone wants to get their friend in getting an assignment. And I actually did a study for a very large plan, and when you got the group decision making in, so I gave them the report, and with all my services, I give them follow-up. You can't just drop an incredible report on them and expect them to digest it and follow it and understand it right away. So in a follow-up meeting, they said, hey, could you take a look at our watch list? Many of these non-discretionary firms, provide a watch list. So if a firm is, underperforming, they'll get a letter, and they say, well, you better turn it around or else, you're going to get fired. Right. And then, say the following quarter, they'll send
the meetings will end when the morale improves, right?
Exactly. What are you going to come in a little earlier to improve returns? Yeah. Anyway, long story short, they said, could you perform an analysis of our watch list? And I did. And what I found is this. By the time they go through all the different iterations of writing the letter, bringing them in, this is your last warning, and then they finally get the courage and emotional will to fire them, it was always, not always, but very close to the bottom of their alpha cycle. Sure. And because they fire managers and they no longer track performance, they never ever see the post-termination performance. And given the timing, they were either better off firing them right at the beginning or not doing it at all. Yeah. But instead, they wrote them all the way down and then wash, rinse, repeat.
Right. So what my inference from that is that actually the single best strategy they should have adopted would be to double down at the trough, right?
Right.
When they're ready to make the firing decision, double the allocation.
I had that exact same client was in that situation after I gave the report, and they did just that. Yeah. And according to, at that point, the chairman of the fund, who since retired, has said, wow, they're now leading the parade. Yeah. So, I mean, my analysis paid for itself.
You just commendably made like a long story short, but I want you to add a little color. I know you don't want to name a name, but give us just a little color, 30 seconds. Like, what kind of an organization was it? What was the governance structure? Roughly how big? Very, very roughly, so we can get a little greater sense of
yeah, it was a multi-employer plan, so both labor and management. They had a non-discretionary consultant. I think today they have about $8 billion. Very large, very successful organization. And again, in Northern California, they've just been doing great. But again, they wanted to just get a little outside view. Is there something we can do better? I mean, Peter Lynch said, no one's going to be right 9 times out of 10. If you're good, you're right 6 out of 10. Yeah. My hope is to get them that one better decision or eliminating one negative decision. So ultimately, they're doing great. That's the difference.
And we know from his recent commencement speech at Dartmouth that Federer won 54% of his points, but 85% of his matches. So, my former partner Jeremy Grantham used to have a great expression. He would say, 80% of manager firings are a mistake. But the corollary to that observation is even more important than the observation itself. Because if 80% of firings are a mistake, which is what you were just discussing, right? Mm-hmm. Let's go back and look, what if we had kept the manager instead of firing them? Jeremy's insight, which I give him full credit for, but I've used 1,000 times in my career, is that 80% of the hirings are tautologically a mistake too, because they're chasing recent success. So always looking with the eye in the rearview mirror, firing in an inopportune time, and then rotating money where? The capital gets rotated into a manager whose relative fortunes are probabilistically peaking at a zenith, only to ride it all the way down again. It's a pretty good way to destroy wealth.
Yeah, let me give you a great anecdote describing just that, David. So I did a study for, again, a large fund, large consultant, and if I told you the name of, I'm sure again most of your viewers and clients would know it. But speaking of the active manager hiring, so I look at the context of the hirings, hopefully trying to find some behavioral finance heuristics. Yes. And over the course of the study period, well, you're going to learn from it. How else are you going to learn from it?
Yeah, we'll come back to that.
So they did 20 hirings, active manager hirings. And so I look at the context of it. 19 of the 20 had outperformed prior to hiring.
Sure, of
okay?
Course. Yeah.
And the only one that didn't outperform had a very short track record, and it had a ESG type governance screen, so they made it in. What percentage do you think of those 20 actually outperformed during the study period?
30 to 40% would be my guess.
5 out of 20.
Yeah, so.
But what was so
25%.
interesting about it, I also looked at, to make room for those new hires, they had to fire.
Of course.
They fired 12 managers. So I looked at the subsequent performance. How many do you think outperformed?
Everyone. I don't know.
8 out of 12.
Yeah.
I mean, they had it completely reversed, and this is, again, a firm that advises trillions of dollars. They have a manager research
Right.
department.
Sorry,
all
the context was a 321 engagement.
And it was 321, exactly.
Non-discretionary, the old model as I call it. Come in, here are the three managers. You can do fine with any of the three, as you said earlier. You are the fiduciary, so you go ahead and you make the actual decisions. That was the context.
Exactly.
A non-OCIO context.
And that model, I think, fosters something what I call defendable decision making.
Mm-hmm.
And if I'm a trustee and I'm a layman and I'm being entrusted to make these decisions, and I could be put under scrutiny by a government investigator, my own constituents, and saying, well, why did you hire this manager? Well, they were the best manager out there. Just look at the past performance. You can't get faulted for that. So it creates that defendable mindset, which is, again, leading to that chasing performance you mentioned.
Let's just circle back, because as I think about what the ground we've already covered, I'm not sure that we nailed down the concept of a real benchmark. Okay. Let's come back to that. What exactly do you mean, and why do you find it attractive, if not essential, for long-term success, to have a real benchmark? That's your term, not mine. Yeah.
Well, I think that a two-benchmark solution would be a vast improvement over kind of the industry practice today of a single and unchanging benchmark. Mm-hmm. And the first benchmark, which we discuss, I call a dynamic specific, meaning for every specific allocation, for every asset class in the investment policy statement, that will be represented in that changing benchmark. Mm-hmm. Okay, so again, the difference between those two was, again, alpha, fees, tactical asset allocation, rebalancing. But then bring another benchmark in, which I call a broad static. So it represents the broad opportunity set. Mm-hmm. Whether it's domestic, you might think the domestic 60-40, or you might take it global, and maybe you have some alternatives. But it's a benchmark, David, that you set that you believe over the infinite future should lead us to our appropriate risk-return goals. So the difference between that broad static and the specific dynamic will reflect the asset allocation changes, and again, between the performance and we'll get to the alpha.
Yeah. Let's go, Eric, if you go to slide 11, I think it's my criteria for designing an investment policy statement. Yeah, it's all on one page here. I just want to take a minute or two to say that based on my experience, that formulation of, others would call it a policy portfolio, the strategic asset allocation, and then maybe the default portfolio, really, really long term. Our risk tolerance as an institution, it could be an endowed charity, it could be a family, it could be a defined benefit pension plan, is roughly equal to the risk that you would bear if you're 70-30, 60-40, what have you. And there's merit to that. There's a good discipline to it. I prefer a different approach, as I think you know. Almost everyone watching us speak will be familiar with my preferred approach. It's the product of applying these criteria for designing an investment policy statement. And what it leads to ultimately, I didn't include it in the deck for today, but again, if people watching us don't have it, they can just ping me and I'll send it to them. I get my investment policy statement, as you may know, Brian, onto a half page. And it basically says, what's the single most important risk parameter, in my view and experience, it's drawdown. Why don't we set up a system, a regime, it takes about a half a page of paper, so that we try to pursue the highest return we can without violating the drawdown or separately some liquidity constraints. That's it. Very simple. And then what are your benchmarks? Well, your benchmarks are, what is the available opportunity set? It's not going to be baseball cards and fine wine for a $50 billion endowment. The market isn't liquid enough, pun intended, right? But you can look at broad indices, whether they're stocks or bonds. You can look at alternative assets as well and say, over a meaningfully long time period, Did the OCIO, or in the case of a non-outsourced, did the Harvard Management Company on behalf of the university, to pick one example, steward the capital in a manner that avoided the drawdown that we deemed intolerable, whatever it's -30, -35, it might be a more muted drawdown, and did they fully exploit or tolerably fully exploit the available opportunity set? It's germane, actually, to the next question I'm going to put to you, because we do an enormous amount of work here in this building and then separately with our content partners at Tier 1 Alpha, trying to understand market structure, which today in 2024 is radically different from what I encountered when I got into the business. It's actually radically different from what I experienced through, I'll say, the first 3/4 of my ongoing career. That's roughly 3 decades.
Yeah.
Right? And I wonder the extent to which you think the fiduciary, the ultimate asset owners, are sensitive to how dramatically markets have changed, particularly here in the United States. The massive influence that passive has over market prices, the anomalous fact that the bigger the cap of a stock, an Nvidia, a Microsoft, an Apple, the Mag 7, so to speak, the less liquid it is, actually, because there's such crowding by the passive players. I could go on, but I'm wondering the extent to which those vastly important factors are coming up in the conversations that you're having with your clients.
Yeah, I think they are. Obviously things have gotten more complex, which we can have a whole nother podcast on whether complexity is a good thing or not.
We should do that.
Yeah, no doubt. But if I can go back to what you talked about with the benchmarking, one thing that I've experienced is something called Goodhart's Law. Charles Goodhart, he was worked at the Bank of England, and he still went into academia, still going strong. Recently, just published a book about global demographics. But Goodhart's Law is, once a measure becomes a target, it ceases to be a good measure.
Yep.
And with regards to what you said about, and I'm impressed that you can put it all on one page. If you go to, when you go to some consultant books, you can go back. I always start at the back of the book.
Yeah.
And they can have pages and pages of disclosures and this change to that. And so Goodhart's Law is this: the chance for gaming is incredibly high. Some consultants are better at generating phantom alpha than real alpha. So with regards to your points on where we have a little disagreement, so long as it's consistent, not gamed, and not constantly changing, I think both methodologies can work in harmony.
Take a minute to describe what you mean by phantom alpha.
So alpha, again, what we alluded to at the beginning was, in most consultant and OCIO reports, there's going to be standardized periods of performance. Most recent quarter, 12 months, 1 year, 3 year, 5 year, 10 years since inception. Yeah. And it'll be performance, and the next one down is the benchmark. Again, what I call a strategic dynamic or linked benchmark. And the difference between the two is what everyone can hang their hat on. Hey, we're ahead of our benchmark. So there's 2 ways that you can beat your benchmark. You can create real alpha through manager selection, tactical, etc., or you can beat your benchmark by beating down your benchmark. And there are so many ways I've discovered that it's done in all facets of the consultant's or OCIO's duties. But as long as it's disclosed, again, whether it's in 6-point font at the end of a book, it's incumbent upon the trustees to not only understand it, but look at, read the disclosures and realize the impact. So for instance, if you look at the CFA Institute's guidelines that they put out, 3-4 years ago, or if you look at standards and rules from the SEC, they really don't care. There are no set hard ways to craft a benchmark. And their view is, so long as it's disclosed,
Sure.
and they don't go into the effect and impact of these changes, but so long as it's disclosed, it's fine. This even includes retroactively recrafting your benchmarks.
I just feel compelled to do a quick sidebar, partly because of what's going on here in the most commendable way that some of my colleagues, some of my sector heads have found frauds.
Sure.
Right? It's kind of a hallmark of Hedgeye's history. And this is to the firm's great credit, long before I arrived here joined the payroll. Have you come across frauds in your work as an OCIO monitor? I don't expect you to necessarily name names, but I mean, serious, what you deem to be pretty serious fraud, the bucks involved are big. These are big bucks.
Absolutely.
Yeah.
Fraud, that's a little bit strong. Again, I haven't found changes that were made surreptitiously. I found that changes were made in such a way that unless the trustees really knew what they were looking for,
Yeah.
and could understand the impact of those changes. I'll give you a quick example. In the early 2010s, one client was moving from fixed income into private equity. And certainly following the 2008 GFC, there was a gold rush mentality of trying to get into private equity as quickly as you can. And many funds really wanted to pepper the field to get in. They had to sign as many LP agreements as they could, 80, 90, just to get in, otherwise they were going to miss the boat. Mm-hmm. This fund didn't quite do that. They took more of a sniper approach. Anyway, it took them about 2 years to get a 10% allocation into PE at a fixed income. What this consultant did was flip-flopped in their benchmark between the actual allocation and the target allocation based upon the quarterly returns. So they were able to, again, keep knocking down their benchmark as they were getting funded. I mean, is that fraud? No, it was disclosed. Is it unethical? That's up to your viewers to describe.
Yeah, I mean, I would ask the question, we can leave aside the loaded term fraud. What exactly does that mean in a court of law or in a court of ethics? But was it their conscious intent to slow down the rabbit? I call it the rabbit, right? The benchmark that they're encouraging the ultimate asset owner to look at to compare actual results to the rabbit. It sounds like they probably wouldn't have done methodologically what you just described if it accelerated the rabbit.
Yeah,
we can infer.
Every time I've seen strawman benchmarks, retroactive benchmarks, going from gross of fee to net of fee, misweighting benchmarks, every time it was done, and I like to say it's they dropped the toast and it always landed dry side down.
Yes, exactly.
Every time
that's a better way of putting the question that I was putting to you.
Every time I saw a change like that, David, it always worked one direction.
All right, so Brian, this in my view brings us to the GIPS standards. I want to take a minute to describe the background here, and then I'll turn it back over to you to discuss. But it ties into Goodhart too. So a few years ago, the CFA Institute, and correct me on any of this if I'm wrong about it, in response to requests and industry pressure, said we're going to promulgate a draft set of standards. There were already pre-existing global investment performance standards for managers. They said we need a new set of standards with some of the IP borrowed from the existing GIPS for managers for the OCIO industry. I've studied them pretty carefully, in part in preparation for today's conversation with you. You've written about them. I think you've written about them eloquently. I'll just say editorially, and then I'll come back and defend the statement if time permits, based on what you're about to say. But I think they do more harm than good. Like if your ultimate goal is to make capitalism efficient, to promote an efficient allocation of capital, this is a disaster in my view. And I'm saying this mindful that there may be people at the CFA Institute, and I've done a lot of work with them over the years, that would say, what's David talking about? He's being, mean. But let me turn it over to you to explain where they came from, what they are, what you deem to be virtues, and what you deem to be problematic about the standards, which are not yet fully adopted and implemented by the industry. Take as much time as you want, by the way.
Sure, absolutely. Yeah. So I believe in the original GIPS standard. I think it was a great success, to bring some standardization, kind of a la Morningstar did for mutual funds. GIPS can help, kind of separate the wheat from the chaff when it comes to managers. If you look at, say, a small cap domestic value, I mean, everyone has against, say, the Russell 2000 value, this is our universe of stocks, this is our stated objective. It's a true apples to apples comparison. Mm-hmm. So I think that's been fantastic. Does it translate to OCIO? And I think we're in agreement there that it's a very tough and heavy lift for a couple reasons. First of all, an OCIO has so many different duties. You're basically turning over the reins to an OCIO, and again, it covers asset allocation, strategic tactical, rebalancing, hiring, and firing.
It's the word chief. It's everything.
Absolutely.
Yeah.
Now, let's add on top of that client circumstances. Is it? Do they have positive cash flows? Mm-hmm. Are they growing? Is it a frozen plan that is dying? I mean, obviously, that alone can affect how you treat illiquid investments.
Sure.
Are there guidelines and liquidity requirements just from paying out, positive versus negative? All these different circumstances can really make it difficult to discern performance, which is something objective and numeric, versus value add. Yeah. So I think trying to conflate the two is very difficult to do. Now let's add on top of that a Goodhart, Charles Goodhart, the gaming of the system. So I first wrote about the draft proposal within days of it doing. I mean, I am my own compliance department, so I can just put it out right away.
Compliance approved the writing.
Yeah.
This was in the fall of 2023, presumably.
Right, within days.
Right?
Yeah, within days.
Yeah.
And thinking like an economist of the Austrian school, which
important qualification. You're not Paul Krugman.
We're looking at the law of unintended consequences. I think that was made famous either by Hayek or Mises back in the day.
Yeah.
And the inevitable gaming. I mean, I found the gaming in all the reporting, right? So here are many instances, whether it be falling into a required OCIO composite, which you put it on the slide deck. So for instance, one of the cutoffs is right at 49%, and the other one goes 50 to 70%.
Yeah, Eric, go to slide 5 as Brian is speaking.
And so
what he's referring
you
to.
get categorized based upon the written guidelines. So you can simply say, well, we're going to change our guidelines to growth assets to 49% target.
Yeah.
But we're going to have a range up to 65%. So we're going to categorize ourselves at 49% in growth assets, but put it at 60% as a permanent tactical.
They've decided that it ought to be the targeted asset allocation as distinct from the actual, which gives rise to the opportunity to gaming.
Absolutely.
Yeah.
Now throw in the fact that the definition of the assets, again, these are per the draft. And I've read several of the responses by OCIOs. I mean, they sent me some of them, and we've had sidebar conversations. What do you think about this and that? And just in the definitions of what is a risk mitigating versus growth asset, also allows leeway. So it's going to create that proverbial race to the bottom in terms of gaming, such that OCIOs that have poor value add may be very good at gaming, so that it might create a perverse incentive.
Yeah, let me comment editorially as the audience looks at, leave the slide up if you wouldn't mind, Eric, because I just want people to stare at it. They don't need to look at me. But I'll offer the following comment. I just hinted at it a minute ago. This does more harm than good, right? It does a lot more harm than it does good, in my judgment and experience, for a whole bunch of reasons you cited, and others that I could catalog, but I won't in the interest of time constraints, right? But it sort of leaps off the page at you when you see words like aggressive, moderately aggressive. The principal objection to any framework like this, or in my experience, to most institutional investment policy statements is that it leads to price insensitive investing, which makes very little sense in the context of investing, right? Your return is going to be a result of what you pay for it, what you sell it for if you ever sell it, and the income you earn in between. Right? You don't want to be a price insensitive buyer or seller under any conditions. Essentially, that's what this is doing in essence. I think it's really perverse. I will say as well editorially, without getting ad hominem, when I read it, and when I looked at this table in particular, I said to myself, the person singular or persons plural who put this together, this draft, probably have very little real world experience managing a total fund or managing anything, frankly, because it's so wildly impractical. There's a corollary that I'll argue for here, and I'll ask you to respond to it, which is that if I were advising the ultimate asset owners, the board of trustees of an endowed charity, the board of directors of a company with a defined benefit pension plan, a wealthy family, even an individual, and I would say, and they're engaged in a search for an OCIO, I would actually ask them or encourage them to exclude firms that claim compliance with these GIPS standards, to exclude them, because I worry about Goodhart. I worry that a firm that is adopted and is trying to manage its business in accordance with this, I'll put it politely, ill-founded framework is likely to have other attributes that cause me to conclude that I don't want to entrust my capital to them. I recognize that what I just said is going to be very controversial for the folks who are advocating for the OCIO industry to adopt standards like this, but I really, truly think it's going to do a lot more harm than it does good. Your reaction?
Well, I read an industry piece put out talking about the reaction of players in the industry to the proposed new guidelines. And a couple of the quotes, I mean, the OCIOs are going to be put into a very difficult position here, because there were quotes in the article by search consultants that said, we're only going to look at firms that are GIPS compliant.
Exactly.
And so again, your concerns about Goodharts and gamings and such, so they're kind of put in between a rock and a hard place.
They meaning the OCIO firms, the consultants, or both?
Yes.
Both.
But some of the ways to assuage it, there is a cottage industry of firms that will verify your GIPS compliance. So I don't know how good that's going to be, because all they're going to do is, are you adhering to the letter of the law, quote unquote law, but are they going to say, well, this smacks of gaming? No, because if they did that, they're not going to get hired. I mean, you don't have that imprimatur of compliance. Yeah,
I'll just make the observation. I suspect you'll agree with it, but you're free to disagree. But the framework that we still have on the screen, the words, the vocabulary, the mindset, is not just different from, but it's almost the diametric opposite of what you see, what I would call leading institutional investors pursuing. The dominant tenor of the times at the very cutting edge of return generation is actually a liberation from these artificial, price-insensitive frameworks and categories, the very best people. I'll point to a few. I think Seth Alexander has shown admirably his willingness, backed by the trustees of MIT, to abandon those kind of frameworks and to have a more very disciplined, but a much more opportunistic approach. I could cite others around the country. I think Rob Wallace is trying to do that at Stanford, the Stanford Endowment. There are smaller endowments. Joe Lee, what he's doing at Abilene Christian down in Texas, who I met with recently. They're trying to liberate themselves from these counterproductive constraints and frameworks. And that's again why I say that I think I would prefer to hire an OCIO firm if I were a search consultant that's not trying to jump through these hoops.
Yeah, no doubt about it. I mean, I appreciate the spirit to standardize it, to make it a little bit more user-friendly to whether it be search consultants or, so many searches are not done, only about 20 to 30% are done by search consultants. So a lot of them are done in-house. Oh yeah, we can do it. We can, line people up, and I hear, these people are good or those people are good. And if they do have the GIPS compliant, it would seem like it would help. But again, even if they're verified, how much gaming is there? And it's not just numbers. They may have poor relative numbers in their composite, but given the client's circumstances and restraints, and if they're not gaming, they might be the best choice. But,
exactly.
But what you're pointing out, the destruction is some of the better OCIOs may actually be losing business even though they have positive value add.
Yeah, we're running out of time. I want to cover at least two more topics, right? Let's go to slide 9 if we could, Eric. I just want to cover to me this is an all-important point. You and I discussed it the other day on a Zoom, but as you know well, and some watching this video will know as well, biannually since I got the MacArthur funding and I left GMO to start TIFF many years ago now, I've done a survey, and you're seeing the results of the most recent edition of this. And people can read the question that I pose at their leisure on the slide. But stating it orally for those who are not watching but maybe out for a run and just listening to us talk, which I often do with Hedgeye IP. Basically the question is, assume you're going to start like your career tomorrow, it's going to run for 25 years. There'll be no interim measurement of your results whatsoever. You can do anything you want with the money that you want. You can hire 1,000 people, you can manage it all yourself, you can put it into a single stock. Again, you have the great liberty of not having any interim measurement of results and no withdrawal of the money. Subject to all those very felicitous boundary conditions, I just have one simple question. If we say that the governing metric, the only metric by which we're going to gauge success, is your compound annual growth rate, net of all expenses, in percentage, not dollar terms, but in percentage terms, my question is simply, how much do you want to start with? And when I put the question to people, I say, obviously you're not going to start with $1, because you can't do anything interesting with it. But you're also not going to start with a CalPERS like 300 billion, because it's just too much. You can't be nimble. So where in between those extremes is your answer to the question of optimal asset size? And I'll just observe when I turn it over to you to try to answer the question with this live recording, right? Is it strikes me that most of the dollars that comprise the $3.5 trillion I alluded to at the beginning of this conversation, roughly 100 firms now, probably more, $3.5 trillion, most of the dollars, the old 80-20 rule, reside with OCIOs whose assets under management are vastly in excess of my own answer to the question that I just posed. What about you?
Well, absolutely. I mean, there's no doubt there has to be a sweet spot, and the way I look at this is it's dependent upon how the OCIO manages. Where are going to be the bottlenecks and choke points when it comes to, say, manager selection. So for instance, many of these firms have these, emerging manager weekends where the managers come in, they give them their pitch, and this is why we're the next best thing, and you should give our little firm some money. So if they really are superior and they're gonna get alpha in the next 3, 4, 5 years, whatever it is, how much capacity can you get with this emerging manager? And for which clients? If you're a fiduciary to all of them, shouldn't they all get, a prized choice of beef?
Yeah. Which is wildly impractical in the case of an OCIO that may have several hundred clients.
Absolutely.
At a minimum.
And you throw in liquid alternatives and rebalancing and, again, limited capacity of managers. I'll agree. I believe that many OCIOs have gone beyond, a size. But if you think of, Charlie Ellis's great quote about his view of investment consultants, he says that their views are not aligned ultimately with the client. It's about getting as many clients as possible and holding on to them as long as possible.
Yeah. So my last question is on the concept of mistake-based learning. You've written about it. Just take a minute or two and then we'll wrap up. What does that mean in your view, and why is it so important? Mistake-based learning.
Right. So this is, Ray Dalio has since made it popular, but I've been thinking about mistakes-based learning, the whole life. I mean, experience is the best teacher. You get the test first and the lesson second. But if you look at the reports that institutional investors are given, the asset owners, by their consultants, by their OCIOs, again, they have those incomplete feedback loops. So they never get the response of our decisions helping or hurting. Again, if we hire a new active manager and we had 3 finalists, sometimes they'll pick the wrong one and the trustees say, oh man, we made a poor decision. But they never see how the other managers performed. They might have only been given poor choices. So again, they will then say, oh wow, we made a mistake. They had some personnel turnovers, all these things happened, let's fire them. And then they'll wash, rinse, repeat, but this time we'll add the fact that we don't know how their post-termination performance was. So again, my point is they never ever see if a mistake is being made and if there's a pattern to their decision making. So they're very limited in being able to improve on a go-forward basis. And that's what you should always be striving to do. If you're not learning, you're falling behind.
Yeah, and I would add, at least in my experience, that the void that you just highlighted, the absence of mistake-based learning, is not merely at the ultimate asset owner level, that there are many OCIO shops that have suboptimal mistake-based learning. They don't go back and do the counterfactual.
That's absolutely.
Maybe even a majority of the 100 or so that we keep alluding to.
Yeah, I mean, that's one of the things that, people say, well, boy, OCIOs and consultants must love you. I said, yes. The real intellectually curious and who have, a strong rigor and discipline do love me. They want an objective view on their own experience, because the hardest thing to do is to really take that hard look in the mirror, and again, very few of them do exactly what you just said.
Yeah, we've got to wrap up. Eric, go back to slide 3 if you would, please. I just want to encourage our folks as we thank Brian for making the time to be with us today. Again, even if you have nothing to do with the OCIO industry, I encourage you to go back. These are the greatest hits. There are a lot of other posts that Brian's put up to his credit on LinkedIn. Read them and ask yourself, to what extent can I apply the principles that Brian is articulating in these writings, because I think he's done a very good job in doing so, and I think you've done a very good job in conversing with us today. So Brian, thank you very much for making the time. You've already promised to do a follow-up episode, and we'll get that on the calendar.
Well, I enjoyed it very much. Thanks for the invitation to sit down with you.
Yeah, my pleasure. Thank you. We'll see you all next time.